This is a clip from Keith's recent visit to the Real Wealth Show. Don't forget to hit like.
News reporters need to understand that they can still freak people out if that's their intention.
Right.
Just give the truth, freak people out. It'll be a different story, but a more truthful one. And of course, some markets are behaving differently than others, as they always do. So let's talk about that. What are you doing today under this kind of environment?
I mean, if you want to talk about particular markets in Florida, I'm seeing property insurance premium increases that are substantial. So on my own portfolio, I'm trying to get rent increases commensurate with those insurance increases, enough to cover them. And oftentimes with this price run up that we've had in real estate nationally, we have not yet had a commensurate rent increase run up. So it's really lately in the Midwest, some of those Midwestern markets, where we're seeing the better ratio of rent income to purchase price, because some of the Southeastern markets seem to have run up in price faster than those in the Midwestern markets. And yeah, Kathy, with the market dynamics, I kind of think of things in two waves. First, there's a housing price run up, which we've seen the past couple years. And then there's a lag time, and then rents struggle and eventually do catch up with house prices. And in the middle of those two waves, there's a trough. And when you're in that trough, that's typically when there's the lowest profitability for a real estate investor, because prices have already run up, but rents have not yet. And what really creates that? What causes those two waves? I'm just talking about things on a national basis now. As prices run up, and now higher mortgage interest rates have fueled this lower affordability, well, that continues to take people out of that first wave. That continues to take people out of that home buyer pool, and they go into the renter pool. So that's why I expect rental occupancy to be up, rental vacancy to be down, and rents to continue increasing at faster than historic norms. So rents need to catch up with prices.
Everything is so cyclical, it seems, because when you see this frenzy in the sand states, right? Florida, Arizona, Nevada, California, this isn't new. This happened last time. People just jump all over each other trying to get property and bidding things up in these markets until it peaks, until affordability is completely out of whack. And then people say, okay, enough is enough. We're going to go where it's more affordable. And then the Midwest starts to really pop. That's when I started investing in Dallas, when California was so on fire in terms of pricing back in the mid 2000s, and Dallas was like just starting its boom. So I agree with you there that there's some really great opportunity. Also, what I love about the Midwest is a lot of builders didn't go there. So you've still got the problem with lack of supply, but you just don't have new supply coming on. But interesting, I want to hear more about the insurance in Florida. I have not seen that happen with my Florida properties. So where are your properties, and what kind of insurance premiums are you seeing?
Yeah, and this is really just something with sort of older existing properties that I'm seeing. With newer build Florida properties that are built to newer codes, I'm not seeing the torrid increases in insurance premiums there. It's with those older existing homes that were built on older building codes. I've seen a doubling of my insurance premiums from talking to my providers there, including in the Tampa, St. Pete area. Some insurance providers just aren't providing coverage in Florida at all anymore. So we were talking about lack of a housing supply before. We're getting less of a supply of those that will provide insurance on Florida properties, especially for those older homes. So that's where I'm seeing some problems there. Fortunately, we are in this environment where I can get rent increases that help offset that. One word that we've each brought up here a few times, and I think it's really important to speak to, is the affordability, a place where we've really seen a constraint lately, whether we're in Florida or the Midwest or whatever market that we're talking about. So I'd really like to talk about that affordability component.
Oh, yeah. Like, where do you find it?
Exactly. It keeps shrinking. It keeps shriveling up. By some measures, the average payment that a homeowner needs to make to buy the median priced home is up 50% when you have this combination of higher prices and higher mortgage interest rates. And I'm going to say something that sounds paradoxical. Higher mortgage interest rates typically correlate with higher home prices, not lower home prices. Almost everyone thinks it's the opposite. I think it's rather rational to think, oh, wait a second, higher mortgage interest rates, that means lower affordability because that makes for a greater payment. So wouldn't that correlate negatively with house prices? No, actually, it is just the opposite. In fact, since 1994, there have been 9 different times when there's been a substantial mortgage interest rate increase, as defined as an increase of 1% or more. And during those 9 rate increase periods over the last 28 years, real estate prices have increased 7 of those 9 times. And maybe you, the listener, the viewer there, if you're wondering, well, wait, I still have a hard time getting my head wrapped around this. Like, what environment would things actually look like in where there are higher mortgage interest rates and higher prices? How about right now, right where you are today? Because in the last year and a half, we've seen higher home prices and we've generally seen higher mortgage interest rates over the past 1.5 years. It's been going on now. And that confounds a lot of people. It's not so much that higher rates create higher prices. It's that, today's economy is a little bit usual, but typically when you have higher mortgage interest rates, that often means that the Fed is raising the Fed funds rate as well. What they need to do is cool off a hot economy where a lot of people are employed. And people typically make purchase decisions not principally based on what the mortgage rate is. They tend to make it based on their life situation. So the point is that, people make purchase decisions based on the strength of the economy and the amount of income that they have. People want to buy a home when they feel stable in their job. That's really the principal consideration, more so than mortgage interest rates. Conversely, when rates are being cut, that typically means that the economy is doing poorly because the economy needs support. So when mortgage rates are going down, that actually increases the chances somewhat that real estate prices are not going to run up as fast. And that is rather counterintuitive to people. But the short story is that the condition of the economy and the American consumer and them feeling confident in their job has more to do with a home purchase decision than what that mortgage interest rate is. Mortgage interest rates still matter. It's just not the primary consideration.